Usually when you look at a corporate balance sheet, it's like reading the blueprints of a brick and mortar building. Cash goes here, liabilities go there. It's totally static.
Right, very traditional.
Yeah. But if you dig into the latest SEC 10K filings or, read through Coinbase's 2026 market outlook, you realize corporate treasurers are rewriting those blueprints in real time. Welcome to this deep dive.
Glad to be diving into this one.
And today we are doing a purely analytical breakdown. Just to be completely clear up front, this is about corporate mechanics, not investment advice.
Absolutely not.
We're synthesizing that Coinbase outlook, the 10Ks, and crypto-quant accumulation data to see the actual gears turning.
And the sheer volume of this shift is, it's where we need to start. Over the past year alone, institutions have accumulated like 577,000 Bitcoin.
So 577,000, that's what, roughly $53 billion?
Yeah, right around 53 billion. And when you factor in the spot ETFs and track these U.S. custody wallets holding between 100 and 1,000 Bitcoin, institutions now control like 8 to 10% of the entire circulating supply.
Okay, let's unpack this because honestly, a $53 billion stash feels a bit like, I don't know, these companies are just digitally stuffing their mattresses with gold, hoping the price goes up.
It does look like hoarding on the surface. I get that.
Yeah, like how is that a sustainable financial strategy for a corporation?
Well, what's fascinating here is that the data actually points to a systematic, long-term dollar cost averaging strategy. These corporations aren't trying to day trade the swings.
So they're just holding.
Exactly. By capturing a tenth of the total supply, they are fundamentally altering the market structure. They're establishing a new baseline of corporate demand.
Which actively reduces that old reliance on retail price influence.
Exactly.
But wait, if institutions are locking up 10% of the supply, auditors must be having a literal heart attack.
Oh, diff.
You can't just sit on $53 billion in a digital wallet without the IRS or the SEC wanting a very clear accounting of it. How are they legally putting this on the books without breaking traditional accounting?
Well, they couldn't, honestly. Not until the ASU 2023-08 accounting standard came along.
Okay, right.
This is the catalyst that takes full effect in 2025. It actually mandates fair value accounting for digital assets. Because before this, companies were trapped in this thing called the costless impairment model.
Which was essentially a one-way mirror of bad news.
Yep.
Under those old rules, if the asset's price dropped, you had to report a loss. But if it skyrocketed, you couldn't report the gain on your balance sheet until you actually sold it.
Yeah, it made no sense for a modern treasury. But the new fair value standard changes everything. Just look at MicroStrategy's latest 10K.
Oh, wow. Yeah, that's a wild one.
By adopting ASU 2023-08 early, they recorded a $12.745 billion cumulative effect net increase.
Almost $13 billion.
Right. That massive bump went directly to their opening retained earnings for 2025. It instantly created just colossal balance sheet equity.
Hold on, though. So what does this all mean? If a company gets a nearly $13 billion bump on paper just because the price went up, the IRS is going to want a piece of that, right?
They absolutely are.
But they haven't actually sold anything. Are these companies really going to be forced to drain their actual fiat cash reserves just to pay the 15% corporate alternative minimum tax on a, phantom digital gain?
That is the exact tension in this new framework.
It feels like a massive tax bomb waiting to go off.
It really is. Replacing the old model creates massive equity, like we said, but it introduces severe cash flow risks.
Yeah.
If companies have to pay fiat taxes on unrealized digital gains,
They need cash?
right, they are suddenly forced to maintain enough liquid cash to service a tax bill generated entirely by paper equity.
Yeah.
That level of earnings volatility is just terrifying for a traditional treasury.
So to justify managing these highly volatile tax-exposed balance sheets, corporate treasuries can't just passively hold these assets anymore.
No, they really can't.
Sitting on them is too risky. They have to generate actual utility to offset that tax risk.
Which brings us to what Coinbase's 2026 outlook calls Digital Asset Treasury 2.0, or DAT 2.0.
Right, DAT 2.0.
Because of that tax exposure, treasuries are moving past simple accumulation. They're transitioning into specializing in the procurement of sovereign block space.
And for you listening, think of block space like enterprise cloud bandwidth or, digital commercial real estate.
That's a great way to put it.
You don't just buy a warehouse to let it sit empty, right?
Yeah.
You buy it to run your logistics through it. Block space is no longer just a token sitting on a ledger.
No, it is a vital business commodity required for daily operational infrastructure.
So treasuries are evolving from being passive storage vaults into active managers of programmable utility.
Yep, DAT 2.0 treats that block space exactly like essential digital economy bandwidth.
So why does this matter to you? Because the very definition of a corporate asset has permanently shifted. We've moved from static, idle cash to programmable, functional bandwidth that actively powers a company.
The blueprints of the corporate balance sheet are completely redrawn.
They really are. Which leaves you with this final thought to consider. If block space is now a recognized, vital corporate commodity, one that generates immense balance sheet equity, how long until auditors and shareholders begin viewing traditional, yield-losing fiat treasuries as the riskier asset?